All right, welcome. Today, we're going to jump into two really different ways of looking at financial markets, technical and quantitative analysis. But we're going to look at them through a specific lens, the lens of behavioral finance. We're going to see how our own predictable human psychology is actually what creates the patterns these two fields try to profit from.
Okay, so here's the game plan. First, we'll tackle the big picture puzzle. Why do these patterns even show up in the first place? Then we'll get into the art of technical analysis, and from there, we'll switch gears to the science of quant trading. And to wrap it all up, we'll see how these two seemingly opposite approaches are, actually built on the exact same idea. So let's start with a huge question, one that kind of challenges the whole idea of an efficient market, right? If prices are supposed to reflect all information instantly, then why on earth do we see the same patterns in stock prices over and over and over again? It shouldn't happen, but it does.
Well, the answer, at least from a behavioral finance perspective, is that markets aren't just driven by spreadsheets and earnings reports. They're driven by people. You have fundamental analysis, which is all about a company's financial health. But then you have technical analysis, which is what we're focused on today. It's about looking at the charts themselves, searching for the clues left behind by the collective actions of millions of investors.
And that brings us right to our first discipline. Technical analysis is basically built on the idea that you can read the market's mind by looking at its history. You're trying to interpret the psychological footprints, all the fear, all the greed, all the excitement that get baked into a price chart. The official definition here sounds a little dry, I know. But at its heart, technical analysis is really the art of reading the room, reading the collective mood of the market. It's not so much about what a stock is truly worth. It's about figuring out where the crowd thinks it's going next.
Now, what's really fascinating is that this entire field pretty much rests on these three core beliefs, which go all the way back to Charles Dow. The first is that the price already reflects all the news. The second is that prices don't move randomly. They move in trends. And the third, and this is the big one for us, is that history repeats itself, because human psychology, well, that doesn't really change.
And that's the absolute crucial point here. When a technical analyst looks at a chart, they're not just seeing lines and squiggles. No, they are making a bet. They're betting on the predictability of human nature itself. The idea that the way people reacted to a pattern in the past is probably how they're going to react to it again. So how do they actually do it? How do analysts try to measure this collective mood? Well, they have a whole toolkit of what are called technical indicators. Let's just take a look at a couple of the most common ones.
Okay, first up, we've got the MACD. The easiest way to think about this is as a momentum gauge. Is a trend speeding up or running out of steam? It compares a recent average price to a slightly older one. So when that short-term line crosses above the long-term one, that's a bullish signal. Momentum is building. If it crosses below, that's bearish. It's just a way to see if a trend has legs.
Then you've got the RSI. I like to call this one the excitement meter for a stock. It's a scale from 0 to 100. If the reading goes above 70, it suggests the stock is overbought. Basically, that there's too much hype and optimism. And if it drops below 30, it's considered oversold, which suggests pessimism has gotten a little too extreme. And of course, you have these classic patterns. A golden cross. That's when a short-term average price punches up through a long-term one. It's seen as a really strong bullish signal. And the opposite, the death cross. Sounds pretty ominous, right? Signals a potential big-time sell-off. Think of them as giant visual flare guns, signaling that a major shift in momentum might be happening. Now, these tools are powerful for sure, but here's the catch. They still need a person to look at them and make a judgment call. One analyst might see a golden cross and jump in, while another might think it's a false signal. And that subjectivity, that's where our own biases can start to mess things up. Which leads us to a really important question. What if you could take these ideas, these patterns, and trade on them systematically without letting your own emotions or biases get in the way? What if you could take the human out of the equation?
And that question brings us from the art of technical analysis to the science of quantitative trading. Quant trading uses math and computer algorithms to make all the decisions. The whole point is to cut out human intuition and emotional error, and instead to rely only on strategies that have been rigorously back-tested, basically proven to work on historical data.
Okay, so this is where it gets really cool. How do quants actually use computer code to profit from the exact same human biases that the technical analysts are trying to spot on a chart? Let's start with a classic example, the long-run reversal effect. The data shows something really strange. Stocks that have performed terribly for years, the so-called losers, have a funny habit of eventually turning around and outperforming the high-flying winner stocks. But why would that happen? Well, the behavioral finance explanation from Dummies and Thaler is actually pretty simple. We overreact. As investors, we get way too pessimistic about companies with bad news, and we push their stocks down way too far. At the same time, we get too optimistic about good news and push the winners up too high. Eventually, things tend to snap back toward a more reasonable middle ground. And when you look at the historical data, it's just wild. This chart shows that over a span of more than 50 years, a portfolio made up of those loser stocks just crushed a portfolio of the winners. It's a clear, systematic profit opportunity created entirely by predictable human overreaction. But now, here's the twist. If you shorten that time frame from several years down to just a few months, you see the exact opposite effect. It's called momentum. Stocks that have been doing well recently tend to keep doing well, and the recent losers, well, they tend to keep on losing. So what's the behavioral cause for this one? Investor underreaction. The theory here is that we're often slow to process new information. So when good news comes out, it doesn't all get priced in at once. It happens gradually, creating a trend that you can actually ride for a while. In fact, a famous study by Jagadish and Statman found that a dead simple strategy, just buying recent winners and selling recent losers, generated an average annual return of about 12%. That's huge. And it suggests this underreaction isn't a fluke. It's a real, persistent feature of the market. So we've looked at the art of reading charts and the science of building algorithms. On the surface, they feel like they're from different planets. But what's the one critical thread that ties them both together?
You know, it really all boils down to one single, powerful idea. Whether you're a chartist looking for a golden cross or a quant programming a momentum algorithm, you are betting on the exact same thing, that history repeats itself, because investor psychology is predictable. Both fields are just using different tools to try and systematically exploit our collective human biases. And that leaves us with one last, pretty provocative question to chew on. As computers and algorithms get faster and smarter at finding these patterns, at exploiting our own human nature, what is the future role for the human investor? Where do we fit in? It's something really important to think about as we move deeper into this automated financial world.